The coronavirus crisis has transformed our property markets back to buyers' markets. But does this mean it's the right time for you to buy a property? Well, that's what I'm going to discuss in today's show, and in quite some detail, because like with most things in property, the answer is it depends. It depends, are you buying a new home or an investment property? How secure is your job? How easy is it for you to get finance at the moment? Now, while I obviously want you to listen to the whole podcast, because I've got a couple of interesting concepts I'd like to share with you, let me cut it short by answering the question. The answer is yes, it's a good time to get into property if you're one of the lucky ones who remains financially secure. Because if you buy well now, you could get yourself set for the growth that's certainly going to come later this year. But in between now and then, there are lots of ifs and buts and maybes. So welcome to this episode of the Michael Yardney podcast, where I'm going to give you more detail about what I see happening to our property markets in the short term, what I see happening to property in the long term, and I'm going to compare this downturn that we're experiencing now with previous downturns and see what lessons we can learn. And I also hope my answer to the many property and economic related questions that are probably going through your mind mean that at the end of today's show, you're going to get some perspective from me, which is going to give you some clarity into what's ahead.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Is now a good time to buy property? Should I hold off? Should I wait for property values to fall further? What's ahead for our economy and the property markets as Australia falls into recession? These are the types of questions I'm regularly answering for our clients at Metropole and for the many journalists who've been asking me for my opinion. And what I've been telling them is that our economy started the year with a little cold and it progressed to a flu, and now it looks like we've got more a dose of the economic pneumonia, haven't we? Just look where we are today. Most of us are working from home. We've become really good at social distancing. Many businesses have closed, hopefully only temporarily. The property markets have been placed into hibernation with severe restrictions on inspections, on auctions. The stock market's crashed. We're heading into a recession. Consumer and business confidence has tanked. So people are asking me, what's next? Well, I don't want to make light of the health issues of COVID-19, but based on my view, having been involved in the property markets for over 45 years, I believe the impact of this on our property markets is ultimately going to be temporary. Now, I know this view may be different to what others are forecasting. There's others out there forecasting a 10% drop in property values, 30% drop in values, and I know there are some overseas doomsayers who are suggesting property values are going to drop 40%, and there's those people who are trolling me on the internet who tell me that this time has come now, the Ponzi scheme is going to fall over. But in my mind, this too shall pass. We're currently experiencing something, I guess, like a terrorist attack, which has delivered a short, sharp blow to our economy rather than experiencing a long, drawn-out war. What's going to happen to our property markets is going to depend upon how long we're in lockdown, how soon our economy picks up, the level of unemployment, and probably most importantly, the level of consumer confidence as we come out of our recession, because consumer confidence is a good barometer of all those other factors put together. Fortunately, our government has learned a lot about handling monetary and fiscal policy during economic downturns, and that's resulted in the slashing of interest rates, the introduction of quantitative easing. Our federal government spent over $300 billion just to build a bridge to get us through this, and then no doubt on the other side is going to have to spend a lot more to kickstart the economy. And at the same time, our state and territory governments have introduced their own support and stimulus packages. Now, sure, unemployment's going to rise to double digits, and unfortunately, some businesses they're just not going to reopen. But the economy is likely to rebound at the end of this year, in the fourth quarter of this year, or early next year, at which time we're likely to experience a perfect storm for property. Recently, the International Monetary Fund has forecast that Australia's economy is going to contract by 6.7% this year. Others are suggesting our economy could contract even more than that. But they all expect, including the International Monetary Fund, that our economy is going to rebound in 2021, next year, and the IMF is suggesting it's going to grow by 6.1%. Now, that's assuming that the measures to contain the COVID virus are successful. Of course, if Australia's economy does experience a multi-year downturn caused by the world economy imploding, caused by something terrible happening in China or in the United States, then of course property values could drop considerably. And I know some doomsayers are predicting this, but that's not the forecast of the credible economists that I listen to, that I follow. So people are asking me, well, Michael, what are going to be the short-term effects of coronavirus on Australia's housing markets? And clearly our housing markets are not going to be immune to the economic fallout. But as I said, the impact on property values is going to depend upon how long it's going to take to contain the virus. No doubt transaction levels, the number of properties being bought and sold, are going to significantly drop for the next 2 or 3 months because discretionary sellers are going to stay out of the market. I mean, it makes no sense to put your property on the market for sale at this time unless you really need to. However, there's always going to be non-discretionary buyers and sellers who do need to transact over the next little while. Remember, there are people who sold a while ago who need to buy, and people who bought a while ago who need to sell. See, in general, buyers are sellers and sellers are buyers. We tend to think as property investors, but remember, the majority of transactions occur from people buying and selling their homes. It's likely that those sellers who need to sell are going to discount the price of their properties just to conclude a sale, and very likely buyers who are in the market at the moment are going to take advantage of this to nab a bargain. And that means property values will drop a bit, but that doesn't mean property values are going to plummet. In fact, as an asset class, bricks and mortar have performed exceptionally well during previous economic shocks. This time round, the banks are giving mortgage deferments, mortgage holidays, not getting out of paying your mortgage, but you don't have to pay it now. So they're not wanting to take on mortgagee sales. They don't want to force people out of their homes or their investment properties, because if it did happen, that would undermine our property markets. Now, in my regular blogs on Property Update, I've given you lots of charts, lots of graphs showing what's happened time after the global financial crisis, after September 11th in 2001, after the Asian financial crisis in 97, 98, after the recession we had to have in 91, one after the other downturns and economic shocks as well. And every time, bricks and mortar have been a very resilient asset class, and they've led us out of the recession. Now, I recognise that a logical argument that's based on the laws of supply and demand suggests that with unemployment rising and with fewer people able to purchase a property, there's going to be less demand. And that should mean property values would fall. Sure, property values are going to fall a bit in the next few months, but don't be concerned about that. If you're not going to buy or sell in the next month or 2 or 3, it doesn't matter to you, because this doesn't reflect the intrinsic value of a property. It's really going to be more a reflection of the market lockdown, because sooner rather than later, we're going to come to a point where property transactions and prices are going to get back to reflecting the fundamentals of the Australian economy, as opposed to the current structural changes taking place. On the flip side of the coin, suppressed transaction activity means we're going to see a build-up of latent demand, pent-up demand, and the markets will rebound in the latter part of this year. Now, I'm going to put a link to a couple of articles in the show notes of this, which shows what's happened in previous downturns. And there's a great chart by Stuart Wames of Pro Solutions Private Clients, and I'm having a separate chat with him on this podcast about that, which suggests a very weak relationship between average house price growth after a downturn and unemployment. Stuart's gone back to 1980 in his charts and shown that unemployment and subsequent 3-year annual property price growth actually had a very, very poor relationship. I know many commentators are trying to compare the current markets to how the markets performed in previous downturns, the global financial crisis or the recession of the 1990s. However, unlike previous downturns, they were essentially financially led. This downturn, it's a medical problem that's morphed into an economic issue because of a short-term shutdown of our economy. And this has led to what economists call a supply-side downturn. You see, even though we'd like to go out, we'd like to go buy things, we can't go out as their supply is limited because a lot of shops are closed. That's different to the normal recessions and downturns we've had, which are more demand-driven downturns because people couldn't buy in those downturns because interest rates went up or because of other issues. This time around, things are different because in the past, recessions have been preceded by economic excesses, by speculation. So in my mind, because of this, and based on the predicted pace of the post-recession recovery, I expect the pandemic to have a more limited, a shorter-lived impact on house prices than the recessions of the 1990s or the global financial crisis. So having said all that, what does this mean for property values? Well, no doubt property values are going to go down a bit. In the short term, I see A-grade homes, above average homes, and investment-grade properties, good properties that investors still want, and there are investors out there looking and buying, I see they could probably fall in value by around 5%. I see B-grade, average sort of homes, could fall in value by about 10%. And C-grade, less than perfect properties, they're going to be the hardest hit. There actually is going to be a flight to quality, and they're going to be really, really hard to sell at any price. But this is going to happen on a very low level of transactions, and the pace of the recovery from that point will depend, as I said, upon the state of the wider economy. But there's certain sectors of the market that are going to be affected more than others. I see apartments in high-rise towers are going to be affected strongly. In fact, it's likely these properties are going to be out of favour for quite some time. People are going to remember what they had to do in this lockdown, and they're not going to want to live in those Legoland high-rise towers. Clearly, the off-the-plan market, poor quality investment stock, I'm talking about investment grade, investment stock apartments, they're going to suffer, particularly those closer to universities, because there's going to be an oversupply of properties when there's not as many students for the next couple of terms. Similarly, I see in the outer suburbs, the new housing estates, the house and land packages, where young families are going to probably have overextended themselves a little bit financially, and some of them are going to have difficulty with jobs. But there is going to be areas where people are going to be a little bit more out of work for a while. Those areas are going to suffer. And I guess in some ways, properties in blue-collar areas where people are going to be out of work are going to suffer a bit more. But on the positive side, households and property investors whose incomes remain stable and secure, they're going to be able to take advantage of this window of opportunity in the property market and historically low interest rates. So this should support a return to stronger levels of price growth in the medium term. People are also saying, well, what does this mean for the long term of our property markets? As I said, in the medium term, property values are going to be linked to the extent that the quarantine measures are going to affect our income, employment, borrowing capacity and credit availability. And some sectors of our economy and housing markets are going to be more affected than others. I guess the largest, most direct industry shocks from coronavirus are going to be expected in tourism-related areas, but as local restrictions ease up before we are allowed to travel overseas, maybe tourism areas are going to get a bit of a lift. Clearly hospitality-related areas where social distancing is now leading to us not being able to go out, they're going to suffer. The education sector is going to suffer due to fewer foreign students being able to travel. Retail is going to be dragged down by low consumer confidence, and I guess we're learning we can shop online. My wife always knew that anyway. And recreation theatres, cinemas, art galleries, they've closed down. Those sectors of the commercial and the, surrounding residential market are going to suffer a bit. However, I'm comfortable talking about the long term. The underlying long-term fundamentals supporting our property markets are going to be good. So let's look at a couple of those. There's nothing new about this. We came into this downturn with reasonably strong fundamentals. Yes, the economy was in second gear, but it wasn't in reverse and was still doing better than lots of other parts of the world. And this was in part due to Australia's strong population growth, meaning we needed to build lots more houses. Now, since 60% of our population growth is dependent on immigration, in the short term, population growth is going to fall. But I see this increasing again as soon as overseas migrants are going to be allowed to come to our shores. They're going to flock to our shores because of the safety. At the same time, we came into the situation with the oversupply of dwellings in many Australia's locations dwindling, going down, and there are very few large new projects on the drawing board. But despite that, we're still having babies and we're still living longer, and there's still population growth and new households forming. People are still getting married, moving on, moving jobs. So we need more accommodation, but we're not going to be building enough. And considering how long it's going to take to build new estates or large apartment complexes, we're going to experience an undersupply of well-located properties in our capital cities in the next year or two. At the same time, interest rates are low. And they maybe even go a little bit lower. I mean, the Reserve Bank's not going to change its rates much, but the banks are fighting for business, and you can get really good long-term 3-year fixed interest rates in the middle twos. Unheard of. In fact, it's never been cheaper for investors to own an investment property. The net outlay, the out-of-pocket expenses, how much you're out of pocket compared to the rent and the outgoings coming in, is the lowest it's been for decades, actually probably forever, considering how cheap finance is today. So as I'm talking about the fundamentals that are going to support our property market, those are factors that are going to make property attractive to investors and owner-occupiers. At the same time, we're going to need more accommodation for the same number of people. Sure, many people live in multi-generational households, but soon millennials, who make up about a third of our property markets, their households, millennials' households, tend to be smaller as they're starting off their family formation, and baby boomers are the other big demographic. 65-year plus baby boomers now who tend to be 2-people households as well, and therefore more 1 and 2-people households means that moving forward we're going to need more dwellings for the same number of people because there's going to be fewer people in each household. That's another factor that's going to drive our property markets. And I can see moving forward a larger percentage of our population are going to be tenants, partly because of affordability issues, but also because of lifestyle choices. And our government isn't providing accommodation for these people. Overseas they are, but in Australia, the government's leaving it to private investors like you and me, to provide this sort of accommodation. That's going to underpin our property markets. And first home buyers are back. They're back with a vengeance, in part thanks to the government's new scheme to encourage them, but also because of cheap finance. And when property values start rising, they're going to jump in because they don't have properties to trade in like established homeowners do. They can't save their deposits fast enough for rising prices. So as soon as there's a hint of property values starting to rise again, they're going to hop into the market. But it's very likely that after we get through the recession, the government's going to have a number of incentive packages to grease the wheels of industry. And it has always used first homeowners as a way of doing this, because they realise that when people buy their first homes, they've got to buy carpets and televisions and refrigerators and all the appliances and all the bed linen, etc. And so the octopus has got lots of tentacles going out. There's a lot of spin-off. So it's a great way to help make the economy move forward. So I can see that being something that's very likely going to happen, as it did after the global financial crisis, as Bob Hawke did as well in the past. And that's going to help our property markets. And as I said a moment ago, remember that moving into this, our economic fundamentals were pretty strong. Sure, our economy's taking a hit at the moment, and sure, the share market is down, but our property markets are underpinned by the fact that 70% of property owners are homeowners. They're in it for the long term. They're not going to sell up their homes. They'd rather eat dog food than give up their homes, and the banks don't want to take on their homes. And we came into this downturn with Australia's banking system strong, stable and sound, partly thanks to the Haynes Royal Commission making the banks more cautious, partly thanks to ASIC and APRA and stricter lending criteria. And even though a few home buyers have overcommitted themselves financially, there should be no real concern about the overall household debt because in general, it's in the hands of those who can afford it. There's currently a very low rate of mortgage defaults, and that's likely to only increase a little bit as we move forward. And as the community starts to become more concerned about the economic impact of the coronavirus, it's likely that there's going to be a flight to quality assets. Why would you invest in the stock market? No use putting money into bank, and so a lot of older retirees, self-funded retirees who are trying to live off their bank dividends, the banker term deposits of share dividends, they're going to look at bricks and mortar as well because it's always stood the test of time. In other words, the share market volatility is going to make some investors, more investors, look at real estate because they recognise it's underpinned by the 7 million homeowners in Australia. In fact, it's the only investment market not dominated by investors. So having said all this, maybe you're wondering, is this a good time to buy property? Let me put it this way. One of the major lessons I've learned from previous downturns is the importance of taking a long-term perspective, which always outsmarts short-term reactive thinking. So for mine, it's always property fundamentals that really matter and drive our markets in the long term. Things like demographics, supply and demand, affordability, availability of finance, and the local economic trends. Those things I just mentioned to you. Of course, we all know the old saying, be fearful when others are greedy and be greedy when others are fearful. Yeah, but it's normal, it's human nature to find it difficult to buy a new home or to invest when everyone else is running around thinking the world's coming to an end. However, now that I've invested through 8 property cycles, I've found that that's exactly the conditions. These are the conditions that present the best opportunities. That means now is a great time to get prepared to take advantage of the opportunities the market will offer. After every global disruption, there's always been an increase in property values, and there's no reason to suggest this time is going to be any different, because as I mentioned a minute ago, the fundamentals are basically sound. In my opinion, for those who've got a secure job and their finances organised, and you've got to be careful now with finance because the banks are very cautious about the industry you're in, the job you're in, and is it secure. But if you have got good finance organised, there's no reason to suggest that this time around it's going to be any different because, as I've already said, the fundamentals are pretty good. So, in my opinion, if you've got a secure job, this is a great time to buy a home or an investment property at a price that you are unlikely to be able to buy, I don't know, a couple of months ago when the market was booming in the big capital cities, when there were more buyers around than sellers. It's likely that human nature is going to cause many would-be buyers, though, to sit on the sidelines, at least for a little while until things become more clear, which means that sellers are going to be more amenable to accepting your offers rather than holding out for a top price. So remember, don't make long-term decisions like buying your next home or an investment property based on the last 30 minutes or even the last 30 days of news. There's no doubt that there's going to be opportunities in this market for those who are willing to go against the crowd, because when they look back in a year's time, and definitely in 5 years' time and in 10 years' time, they're going to remember these unprecedented events in 2020. Hey, we're never going to forget 2020, but those who got in are going to see the great buying opportunity that they have for property, just like those who bought in the global financial crisis and those who bought in all the other downturns. But I know some of you are thinking, oh, Michael, you're an optimist. Is it really a good time to buy property? You know, those people who are waiting for the optimal time to buy a property, they're always going to be around. They either wait until everyone else starts buying, or they wait and they ultimately do nothing at all. The thing is, neither of those strategies make any sense. One is as silly as the other. You might think that's a little odd, because surely buying something is better than not buying anything at all, but you'd be wrong. You see, buying when everyone else is, when your friends tell you it's the right time, when the media tells you it's the right time, often means you end up being driven by FOMO. You remember that fear of missing out that occurred at the beginning of this year, at the end of last year, a couple of years ago. It sometimes means the property you buy is overpriced or possibly inferior. On the other hand, buying nothing doesn't actually improve your financial situation either, and people who suffer from analysis paralysis generally struggle to ever take the next step, to actually buy something. So I know those two examples are extreme, but they do reflect a huge number of Australians who are keen to stake their claim in the real estate market, but they either buy at the wrong time or they don't buy at all. In contrast, savvy property investors understand that the best time to buy is when they can afford to do so, regardless of the market conditions. Now may be that time for you. Smart investors recognise that there are a number of capital city markets around Australia, each experiencing different conditions at the same time, and within each market there are different locations that will do better than other. Not necessarily in their backyards. So now's the time for you to take action, to set yourself up for the opportunities that are going to present themselves as the market moves on. And you can trust the team at Metropole to provide you with direction, with guidance and results. You see, in these challenging times, like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation. And that's exactly what you get from the team at Metropole. Remember, we don't sell any homes, but we don't sell properties at all, but we give you advice and guidance. It starts with strategic property advice. Allow us to build you a strategic property plan, customise one for you, for your family, bringing your future into the present so you can do something about it now. Yes, we've got a buyer's agency that can help you buy the right property at the right price with our on-the-ground teams in Melbourne, Sydney and Brisbane. We don't fly in and fly out. We have wealth advisory, property management, renovations and development. Go to metropole.com.au. There'll be a link in the show notes, metropole.com.au, or call us on 1300 Metropole, and I'd love my team and me to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Many people say the four most dangerous words in investing are, it's different this time. I'd like to put a different spin on it. I think the four most dangerous words in investing are, it's different this time. You see, it's not different this time. We've had pandemics before. We've lived through difficult times before. So why are we seeing it as so different? Well, it came home to me when I read a great column by Morgan Housel in the Collaborative Fund blog. I first came across Morgan Housel when he wrote regularly for Motley Fool, and he explained that some things never change. Greed, ego, fear of missing out, gullibility. He suggests they were with us 1,000 years ago, and they're going to be with us in 1,000 years' time. And you know what? I think he's right. Housel also explained that other things have short shelf lives. He says you can't believe in capitalism while assuming the world is static. He went on to say that technology changes, laws change, social expectations change. And he's right. He explained that history is really only interesting because people marvel at how different things used to be. And when you think about it, yeah, that's right. The trick, you may well call it a trick because it's so hard, is to separate those indelible behaviours, those behavioural biases that you've heard me talk about before, to actually compare today's ordeal to the past. You see, we've been through pandemics before, but that was then. To make sense of how COVID-19 is affecting us, we should acknowledge what's different this time, he suggests. And he says one of the big changes is that the expectation amongst developed Western nations that pandemics were a thing of the past makes suddenly dealing with one feel so much more impactful. Yeah. Then he goes on to cite historian Dan Carlin from his book, The End is Always Near. So let me just read this out to you, please. Dan Carlin said, pretty much nothing separates us from human beings in earlier eras than how much less disease affects us. If we moderns lived for 1 year with the sort of death rates our pre-industrial age ancestors perpetually lived in, we'd be in societal shock. Will we ever again have that type of pandemic that rapidly kills large percentages of the population? This was a feature of normal human existence until relatively recently, but seems almost like science fiction to imagine today. Now, interestingly, going back to Federation 1900 in Australia, and in fact around the world, we died of diseases, infectious diseases, in very large numbers. People died frequently, and that's disappeared nowadays. Life is, in general, about as safe as it's ever been, and effectively, a lot of our improvement over the last century has come from the decline in infectious diseases. Maybe the best thing that's happened to humanity. Now, why I'm explaining this to you in our mindset message is to help you understand why we're behaving the way we are. Sure, we're medically more prepared to fight disease than ever before, but psychologically, the mere thought of a pandemic has never felt so foreign, so unprecedented. What was tragic but an expected part of life 100 years ago is now a tragic and inconceivable part of life today. Compared with other pandemics, even as recent as those in the 1960s, and I'm old enough to remember those, it's different this time because so few people today had the slightest expectation that an infectious disease would ever impact their lives. And even if COVID-19 ends up being medically less impactful than those pandemics that happened in the 50s and the 60s, the shock, the surprise, the effect of it will probably be greater. What I found also interesting in Morgan Houssel's article was he quoted Clark Welton, who explained about a letter that he received from his mother. So I guess this would be coming from somebody my grandmother's age. And this is what it said. It said, "My mother once showed me a list of the contagious diseases she survived before the age of 20. And on that list were the usual childhood illnesses, along with deadly afflictions like typhoid fever, pneumonia, diphtheria, scarlet fever, and the lethal 1918 to 19 Spanish flu, which took more than 50 million lives around the world." He then went on to say, for those who grew up in the 30s and 40s, there was nothing unusual about finding yourself threatened by contagious diseases. Mumps, measles, chickenpox and German measles swept entire schools, swept entire towns. And I personally remember polio was an epidemic that affected generations. In fact, only years before me. I was in the first year of school children in Australia to have polio vaccine, that little pink syrup that you had on a spoon. Generations before me didn't have it. And what that meant was that my generation onwards didn't have it, but people older than me were paralysed, mainly children actually, or died. There were no vaccines. Growing up meant running an unavoidable gauntlet of infectious diseases for college students in the 50s. There was the Asian flu was a hurdle for people in the 60s. Compare this to our generation. Today, my kids' generation, my grandchildren's generation, they enjoyed dozens of vaccines within the first weeks of birth. We live in separate worlds to back in those days. I can't fathom what was normal a couple of generations ago, but my guess is if COVID-19 struck in the world 1920 or so, when my mother was born, it would have been a single page in history books about yet another deadly pandemic wedged between that long list of common tragedies. But since it's happened now, in 2020, it'll be a generation-defining event that fundamentally reshapes how we think about risk. And to conclude his interesting article, Morgan Housel reminds us that the biggest risk is always what you don't see coming. A big hit you expected leaves less of scar tissue than a smaller hit you never imagined. Clearly, COVID-19 would be a big deal in any era, but the fact that it struck people who assumed it would never happen to them makes me think it's going to leave a mark in many ways other pandemics never did. Well, that was a lot of me in today's show, wasn't it? It was just me and no guests, but sometimes it's important to get the message that I want to get across to you. So in the first part, I explained to you what I see happening in the markets today and why, if you're one of those who's in the position to have financial security, a secure job and the ability to get finance, it's worth considering taking advantage of the opportunities that the market is already presenting. And it's going to take a bit longer than normal to put plans together, to get finance together. So why not have a chat with my team at Metropole to build a customised strategic property plan for you to help you take advantage of the market as it moves forward. And in my mindset moment, I thought it was worth going back to the past just to see how different things are today and why we feel the way we feel. If you got some benefit from today's show, I'd really appreciate you telling somebody about it. Part of my aim is to make as many people financially fluent, more secure, more certain about their financial futures. And if you can help me pass the message on, that'd be great. I'll be back twice a week with the regular Michael Yardney podcast, but in between you can catch up with me on social media or my daily property market update. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?